Meta just cut their London headcount by 30%. Amazon's Shoreditch office is half empty. The startups that were meant to turn London into Europe's Silicon Valley are shutting down every single week. Property prices in tech-heavy areas are not adjusting, they are crashing. Shoreditch is on roughly 20%, King's Cross is down close to 18%, and this is not the bottom, this is the early stage. The mayor keeps saying London is a global tech hub, but I've been tracking the numbers, speaking to people inside these companies, watching actual property transactions, not asking prices, and the reality is very different. The tech money that pushed London property prices to completely unsustainable levels is leaving, and when that money disappears, the property market that depended on it starts to break. To understand how bad this is going to get, you need to understand how extreme things became. Between 2020 and 2023, London went all in on tech. Every American tech giant wanted a London office. Every European startup wanted London funding. Interest rates were near zero. Venture capital was everywhere. Money was cheap. Confidence was high. And nobody was asking what would happen if it stopped. Google paid over $1 billion for a single building in King's Cross. Meta took office space designed for 4,000 workers. Amazon expanded aggressively across Shoreditch. TikTok signed the largest office lease in London's history. Salaries exploded. Graduates were earning £60,000 to £70,000 straight out of university. Senior developers were on £200,000 or more, plus stock and bonuses. These people had huge incomes, easy credit, and complete confidence that prices would keep rising.
So they bought property. They competed with each other. They paid whatever it took. A converted warehouse in Shoreditch worth around £400,000 in 2019 sold for £1.5 million by 2022, and buyers fought each other to overpay. That surge didn't stay contained. Hackney became unaffordable almost overnight. Bethnal Green gentrified at speed. Peckham filled with tech workers who could no longer afford Shoreditch. Estate agents couldn't believe what they were seeing. Cash offers everywhere. Properties selling instantly. People paying far above asking price just to win. Everyone assumed it would last. Then the layoffs started. Not the ones in the headlines, the real ones. When Meta announces global job cuts, they don't break down how many are in London. Same with Google, same with Amazon. But office occupancy doesn't lie. Meta's King's Cross campus was built for around 4,000 people. Current headcount is under 2,000. That is 2,000 high-paying jobs gone. Amazon's Shoreditch office was designed for 1,500 people. Fewer than 700 are there now. Google still talks publicly about growth, but entire floors are empty. Teams have shrunk from 50 people to 10. Projects have been cancelled, budgets frozen. The startups have been hit even harder. Fintech firms that were meant to disrupt banking are gone. AI startups have run out of money. Crypto companies collapsed completely. A tech recruiter I know went from placing 5 people a week last year to placing 3 people total in 6 months. The jobs are no longer there. When the tech jobs disappear, the property market follows, not in asking prices, but in completed sales. A flat in Shoreditch that sold for £900,000 in 2022 recently sold for £650,000. That is £250,000 wiped out in under 2 years. In King's Cross, real transaction prices are down at least 20%, in some cases more.
What is even more concerning than prices is volume. In Hackney, sales activity is down around 45%. Properties are sitting for months without viewings. New build developments built specifically for tech workers are effectively empty. I counted lights in a King's Cross development recently. 300 apartments, fewer than 40 occupied. Developers are offering stamp duty paid, free service charges, furniture packages, anything they can. It doesn't matter. The buyers are gone. The rental market is breaking as well. Premium rentals that used to go for £3,000 to £4,000 a month are sitting empty. Landlords are cutting rents by 30 to 40% and still cannot find tenants. This is because tech workers are not just losing jobs, they are leaving London altogether. Europeans are going home. Americans lose their visas when the job goes and have 60 days to leave the country. British tech workers are leaving too. Dubai, Singapore and Dublin are actively recruiting. When remote work is normal, there is no reason to live in the most expensive city in Europe. London lost tens of thousands of international workers through 2024. These were workers, not students, not tourists, people who paid tax, paid rent and bought property. They are not being replaced. Tech hiring in London is down roughly 70% from peak levels. The new jobs being created are mainly hospitality and retail. You do not support £1,000,000 property prices on £25,000 salaries. At the same time, City Hall remains in denial. Public speeches still describe London as the undisputed tech capital of Europe. London Tech Week was half empty. Sponsors pulled out. Startups that once launched there no longer exist. Investment figures from 2022 are still being quoted, ignoring the collapse that followed. Privately, the tone is very different. Internal modelling now includes property price falls of 25 to 30%, collapsing tax revenue and businesses leaving the city. Publicly, everything is fine. Commercial property is the next domino. WeWork has shrunk dramatically in London. Entire office blocks sit empty. A Shoreditch office building that sold for £50 million in 2021 recently traded closer to £30 million. That is a 40% loss. Pension funds are exposed to this. When these assets are marked to reality, billions disappear. That includes retirement savings. Early 2025 is when this becomes far worse. More layoffs are already planned. Commercial lease defaults will accelerate. Institutional investors will start selling. When large funds panic, prices do not drift down, they collapse. The government cannot stop it. Stamp duty cuts would destroy revenue. Interest rates cannot be cut aggressively while inflation remains. Buyer subsidies are unaffordable. By mid-2025, London property prices are likely down 25 to 30% from peak. That is conservative. This is not a normal cycle. It is a structural change. Tech companies no longer need expensive London offices. Workers no longer accept London living costs. That knowledge does not reverse. London built its property market around high-paying tech jobs. Those jobs are disappearing. The workers who pushed prices up have left. The economic model is broken. Prices are not correcting, they are collapsing. Down 20% already in tech-heavy areas, likely heading toward 30, possibly 40%. And yet the public messaging does not change. London is open for business. London is a tech hub. Affordable housing promises while values fall. The people who bought into the London dream are watching their equity disappear. The city that claimed to represent the future is becoming a warning about excess, denial, and overconfidence. This is not a correction, it is a collapse. The tech workers came, pushed prices to extremes, and left. The bubble they created is bursting. Those in power will not admit how bad this is going to get, but the numbers do not lie. The exodus is real, and London's time as Europe's tech capital is over. If you want clear data, honest analysis, and real reporting on what is actually happening in the UK property market, like this video and subscribe to UK Property Report. New updates are coming, and this story is far from finished.